Okay, so let's get a little bit of a market wrap, and to tell us his thoughts on lithium, Martin Crabb joins us from Shaw & Partners. Welcome along. So the lithium story today, I mean, I can see it's an absolutely wild ride out there at the moment. You can kind of see when a market is losing or trying to grapple for a new narrative. What do you see going on out there? Because again, clearly volatile, wild ride.
Yeah, it's all the froth's coming out of it, right? So these companies were valued at almost nothing sort of 3 or 4 years ago. No one had ever heard of people like Pilbara and Allchem and the old Orocobre, but you know, they got up to a 50 billion valuation at one point, and that collective group of stocks, and I counted about 18 or 20 that are listed on the ASX that have got lithium in their name, or they've got some lithium exposure like MinRes and Independence. Yeah, so they've come off a long way. There's a couple of short attacks. I think Lake Resources was one that was targeted with a short attack, and there was a Goldman's piece a couple of weeks ago saying there was a new technology that looked to disrupt traditional lithium hydroxide. So not using spodumene, using some other process, and which would flood the market with lithium. It is a very common element in the earth. It's just very hard to get out of the ground in commercial quantities. So it's kind of this theme of froth coming out of the market. It doesn't matter if it's crypto or buy now, pay later, like Klarna had a down round, 85% fall in valuation. So all the heat is coming out of the market, which, you know, tends to suggest you know, a little bit of retail capitulation and people just wanting to get out of these names. But yeah, that sector, I mean, there's now 6 stocks in the ASX 100 that have some sort of lithium or rare earths business. So it's quite a big part of the market. It's kind of bigger than Woolies, right? It's quite significant.
Lynas was one of the companies coming under pressure today as well. But
Yeah.
when you look at that chart, do you start thinking, ooh, maybe a buying opportunity?
Yeah, I think so. I mean, I think kind of longer term as an Aussie investor, I want to invest in battery raw materials because I'm not going to go and buy the car makers. That's all too hard. Tesla's valuation is just crazy. And who the other manufacturers are going to do well? Is it going to be Volkswagen? Is it going to be Toyota? I don't know. What I do know is that they'll use nickel, cobalt, lithium, rare earths in the produce of those cars. So whether it's 50% of the world's vehicles or 100, who knows? But I just got to pick my entry point because if I could have taken that same thesis and charged into these names at a 50 billion valuation, it's now 30 billion valuation. So just trying to pick an entry point is the tricky thing.
Is it also difficult to try and find the companies that are actually worth their salt? Because I always think in these, you know, draw the parallel to buy now, pay later.
Yeah.
The news today that we got, it, you know, clearly illustrates there's some junk companies out there.
Yeah.
Pardon my French, but you know, how do you sort of pick, you know, the ones that are going to stick around and the other ones who are just hype with a lithium in their name?
Yeah, I mean, I think the ones that have got a mine that's in production, so Pilbara and Allchem and probably MinRes through their operation, they're up and running, they're selling product at the moment, they've got customers, they've got offtake agreements, whereas someone who's got a deposit and who needs to spend hundreds of millions of dollars in capex and maybe not have the customers lined up, or maybe just, you know, there's a motor vehicle company's taken a stake, I think they're a lot more risky. So I think you're better off, I'm a bit more conservative, I'm better off just buying Pilbara because it's producing, or Independence because it's got gold if lithium doesn't work. So that's probably the safer way to play it.
Well, the party really ended in April for a lot of these mining plays, didn't it? But that's because people started to become very concerned about global growth. Look to China, and we still have big concerns about China, particularly with this COVID zero policy continuing.
Yeah.
Is China the canary in the coal mine for you, or are you also keeping an eye? I mean, where are your expectations lie when it comes to recession in the States?
Yeah, I think it's interesting. The OECD Composite Leading Indicator came out last night for, you know, and they've got indices there, which I've just shown the OECD in total, which is the orange line, China, which is the black line, and the US, and obviously the OECD and the US are pretty highly correlated. But China went into COVID first, came out of COVID really, really fast, and it's been slowing for almost 2 years now. And we keep looking for something out of Beijing that says we're going to, you know, kickstart the economy, we're going to cut rates, we're going to boost spending, and everything they're doing is very gradual. They're sort of almost trying to engineer a soft landing as opposed to trying to do a rebound. Having said that, they are out of sync with everybody else. They're cutting rates, they're looking to stimulate, they're still dealing with lockdowns. They're kind of, you know, where the rest of the Western world was probably 6 to 12 months ago in terms of their monetary settings. So I think from that perspective, it's counter-cyclical. So I think if you think the world economy is going to slow, China's probably going to outperform it. Its economy will grow at 3, which for China is incredibly slow, but that might end up being a good number for next year. So I think China's kind of counter-cyclical. Are they going to do enough to keep commodity prices where they are? Kind of hard to say, because the rest of the world's slowing. China's not going to make up the slack. And when it comes to recession in the US, I mean, everyone's betting on recession. Just look today, if you look at the sectors that did well, supermarkets, healthcare, defensives, utilities, stocks that do well in a recession, the stocks that got trashed are the cyclicals, banks and miners. And you just see that every day. Every day there's a net extra dollar betting on recession. Every day there's another bank that's going underweight equities or getting concerned. We saw overnight one of the big banks we follow cut their S&P price target, cut their PE, cut their earnings per share. We also saw a note that said that for the first time in a long time, spot commodity prices are below people's models. So we've had this begrudging upgrade cycle for 18 months because spot prices are up here and the models are down here. For the first time in a long time, they're the other way. So it feels like the whole narrative is rolling over.
So given all that you just said, do you think that there's more opportunity in Chinese tech? I mean, it's got its own regulatory burdens, but still been sold off significantly, or US tech?
Yeah, I mean, US tech, the PEs are still pretty ritzy, right? So everyone thinks, NASDAQ sold off 30, 40%. I saw something saying it's been the biggest PE de-rating since 1965 and all this sort of stuff. And I said, well, what are these stocks trading at? Here we've got the two biggies, Apple and Microsoft, 12-month forward consensus earnings, so PE's based on that. And you see pre-GFC, you're looking at sort of 10 to 15 to Apple and 20 to 25 for Microsoft. They then went nuts because everyone wanted to own them during the pandemic because everyone was going online, and they've sold off a bit, but they're still trading at or above PE levels they were pre-GFC, and bond yields are much, much higher. It makes no sense. These stocks don't look that cheap. So China tech is a little bit like betting on red at the casino, right? Because what's the government going to do? Ant Financial, they killed that float. They went after Jack Ma. Who knows what they're going to do? So I think a portfolio approach makes sense to China. There is an ETF, and I haven't been paid to say this, is an ETF called CNEW, which is China Tech, which looks interesting. It trades on the ASX. So people want to pick up a little bit of exposure in their portfolio, maybe something like that, because they're not taking risk on one stock. They're just buying the thematic of Chinese technology stocks. So worth a look, I think, Nadine.
Just in terms of the states as well, a bit of a change of tax. We've got earnings season coming up it's already basically kicked off, but the banks kind of herald the start of the media hype around it.
Yeah.
We spoke about how every analyst and every bank are, basically positioning defensively, calling recession, all this kind of stuff. I mean, how significant is the outlook going to be for some of these companies this quarter? I mean, surely everyone's just waiting for corporates to come out and say, yeah, we're heading for a slowdown. This is bad news.
Yeah, I mean, I think it's inevitable. PepsiCo tonight, so big consumer products business. Look, and it might be, just one anecdote, but that's going to be interesting. And as you said, the banks, you've got all the money center banks and the investment banks the rest of this week. They'll be going okay because interest rate spreads are growing. They won't be seeing signs of distress yet. Credit spreads are blown out, but we haven't seen employment start to tick up. We haven't seen growth slow. So the banks will probably be saying, hey, everything's great. Jamie Dimon's always a bit bearish, so he's going to come out from JP Morgan and say rates are going to 6% and get ready for the worst recession we've ever seen and all that sort of stuff. So he'll be the usual damp squib that he is, right? But yeah, I think everyone's waiting for confession season because top down, the economy's going to shrink and earnings are going to go backwards by 10 to 20%. And yet every Wall Street analyst has got them going up 10%, monotonously every quarter for the next 3 quarters.
Well, would you be buying? I mean, just circling back to some of those big US tech stocks, because, would you be buying tech here?
No, I don't think so. I mean, our positioning has been for a while defensive, and it's really about growth and financial conditions. Until those things change, until we start seeing interest rates level out and credit spreads start to come down and mortgage rates start to peak, and then on the flip side, we start seeing some signs somewhere in the world that growth's accelerating, we're just going to stay conservative. We're going to stay underweight equities. And then when we do move into equities, it'll probably be across the board. But within equities, I think we have been adding tech. So we added some Xero, we added some Altium. When it felt to us like the bond market had peaked and inflation expectations started to roll over, that big sell-off and growth was finished then, the PE contraction. So as long as you've got earnings growth, and not all of tech does, but something like Xero just keeps adding customers every month.
Technology one.
Not when I look at that closely, but that could probably be another one that fits that camp as well. Just seems to be adding to its business as we go. But there are some businesses, like I saw today, Amazon Prime's peaked out in terms of their new ad, so at 20 million or something, and they're not adding to that. So you've got to be careful that the company's got a long runway in front of it, because Netflix got killed for the same reason, right? It stopped adding. So as long as you've got a good runway in front of you, you should be okay. And they're the sort of stocks you want to add as we rotate out of cyclicals into quality growth stocks.
So excited for earnings season, both the quarterlies in the US and here.
Very exciting.
Tonight, inflation in the States. What are you expecting? Volatility around it?
Yeah, look, everyone's saying sort of it's going to tick up a little bit from 8.6 to 8.8. There's some people as high as 9. You know, a 9 handle would get the bond market a bit scatty again, and we'd probably see another sell-off. But anything on the downside is going to be met pretty well, because this peaking inflation narrative, we already know that oil's $15-20 a barrel lower than it was in June. Are there signs that June was starting to slow anyway? That would be good news for the bond market. So should be a pretty wild ride on Wall Street tonight.